Hello and welcome to our series of financial analysis. Yes, please feel free to subscribe so that you can get the notification of our following videos. Today I'm going to take you through a 12-month rolling cash flow forecast. Yes, there's some information which have been provided here. We have the assumptions, we have the income statement information, balance sheet, cash flow statement, and we also have the supporting schedules. Yes, apart from that, we also have some information, the assumptions which were provided by the company. Yes, we have the revenue assumption, as you can see. We have all those assumptions. Yes, and before we start, we will be able to make some few adjustments on this particular Excel. What we're going to do is we are going to get the end of each month for the actuals and for the forecast. So we're going to use the formula of end of month there, where we are going to have the start date. The start date is in P2. Then we are going to add it with 1 month moving forward. So we're just going to fill that right. And there we are. So we are going to be focusing from 31st January to 31st December 2023. So this is a balance sheet check. This one is going to be used to check whether the balance sheet is balanced. So if it is okay, if error into if error absolute value, that if it is greater than 1, then bring an error. If it is not, bring okay. So this one is going to help us to check if our balance sheet balances. So let's add the assumptions which we already have. Okay, so from here we have the assumptions on the number of stores. We're going to take this value here, then we add it to our forecast. Okay, we also have the assumption for the gross margins, which is that one. We're coming to our gross margins under forecast. We add it there. Then we also come to our effective tax rate. Effective tax rate, we add it there. And now we come to working capital assumptions. We add the working capital assumptions there. Okay, then we come to capital expenditure assumptions. We add it here. Capital expenditure assumptions, we add it there. Then we also have the financing assumptions. The financing assumptions is added there. Then we also have term debt issued assumptions. Yeah, there is going to be there. Then we have debt equity ratio. That one we are going to use later on, so can go back and we add this one here. Yes, so we have transferred all the assumptions to our Excel where we are going to work. Then there are other adjustments that we'll need to add. As you can see here, time periods. Time periods in a year, we expect it to be 365. So we're just going to fill that right. Yes, then the days in the period. The days in the period is going to be the difference between the months, the number of days in months, those months. So we are going to get that. We're just going to fill that right to get the number of days in that particular period we are going to deal with. So those are the number of days in those months. Then we also have periods in a year. Periods in a year, we expect it to be 365 divided by the number of days in period, which is going to be, we fill that right, and we're going to get that. But as you can see, this is going to give us 12.2, 11.8, some are going to be even 13, which is not going to give us we understand that the number of the periods in a year, they're supposed to be 12 months. So make this give us a 12 month, we are going to use a function round, where we're going to round off the division between C7 and C8. But because the days in periods also vary, we are going to use the function mround to give us that value to the nearest 10. Then the round is going to be in 0 decimal. Then we are just going to fill that right to give us the periods in a year. So as you can see, all of them are going to be 12. So those are the periods in a year. So that is the modification that we have done to our Excel. Please watch the next video as we continue.